welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is John Olegas, and John is the owner of a company called Truth in Options. He is the co-author of this book, Getting Started in Employee Stock Options. The book is published by Wiley, and it's available in some bookstores, also available at Amazon.com. And since I'm also going to be pitching in a little bit here today, and also do a lot of work in this area, I'll let you know I also have a book. It's called Secrets of Tax Planning for Employee Stock Options, 2009 edition. This is available at Amazon.com and at my website, www.stockoptionadvisors.com. So with that, I want to give more of an introduction here for John so you get to know a little bit about him. He also writes an email newsletter called Truth in Options. He is the owner, as I said, of Truth in Options, and was formerly a member of the Pacific Stock and Options Exchange and the Chicago Board Options Exchange. John co-founded Options Research, the first analytical service to provide theoretical option values to market makers and the general public. For years, he was considered one of the leading options market makers in the world, having created many of the trading and hedging strategies used today. In his younger days, John was a pitcher in minor league baseball, including the Reno Silver Sox. And his first minor league game was against the San Jose Bees right here in San Jose, where we're playing and we're recording our show today. Also, I want to thank John because he's come a long way to be with us today. He's from Louisiana. And today, John and I will be talking about hedging strategies relating to employee stock options. Now, before we get started, as I often do, I want to caution you, this is a complex area. We're going to be hitting some highlights, and this may be the beginning of a discussion that you have with your investment advisor and tax advisor. We want you to seek that advice, preferably with someone that understands option hedging strategies. So, with that, let's get started, John.
All right, Michael.
And
thank you for
again.
the nice introduction.
You're welcome, and it's such a pleasure to have you with me today. So, we're going to dive right into this. What is the objective of hedging strategies for employee stock options?
All right. These options have a value when they're granted, and it's substantial. It's not an incidental amount. Mm-hmm. On a reasonably volatile stock, an option that's granted to an employee to buy 100 shares at 20, for example, might be worth between 40 and 50% of the market value of the stock. In other words, if you have the right to buy 100 shares of ABC company, which is reasonably volatile, that option may be worth $800, mm-hmm. which is about 40%, or up to $1,000. So you have a substantial amount that's granted, and there's a good chance that the stock won't be above the exercise price when these options expire. Mm-hmm. And if they're not, you get zero.
Yes.
So there's a substantial value that's granted to the employee as part of these options, which are substitute compensation for cash or some other type of compensation. So you have quite a good value even at the day of grant. And if the stock goes up substantially and it doesn't take too long to go up, you have even more value. Mm-hmm. The value which was worth $800 may be worth $1,500. And we're just talking about 100 options. If you're talking about 1,000 options, the theoretical value may have been $8,000 at the time of the grant. If the stock goes to 40, for example, from 20, and you have a right to buy 1,000 shares, the theoretical value of those options may be worth $25,000. Mm-hmm. Okay, now there's two components of that value. Yes. One is what they call intrinsic value. And that value is the difference between what the stock is trading for and what you have the right to buy it for as a result of this contract that you have with the company. Okay, if you have the right to buy it at 20 and you have the right to buy 1,000 shares and the stock's trading at 40, it has an intrinsic value of $20,000. But it has an additional value, and that's what we call the time value or the time premium.
Yes.
Okay. In the employee stock options arena, they call it time value. When I was trading market makers, we call it as market makers, as a market maker, they call it time premium.
Okay.
Okay. So it means the same. Okay. And so, for example, on a reasonably volatile stock, if you have the right to buy the stock at 20 and it's trading at 40, you have $20,000 worth of intrinsic value, and there's probably another 4 to 5 to maybe even more time premium that's in that value. And it's theoretical because they're not trading these options. There's a prohibition against trading them, but it's there. It's not an illusion. And if you make an early exercise with, say, 5 years to go or 6 years to go, and a lot of times stocks do go up double in 3 or 4 years.
Yeah.
You are forfeiting part of that company. I mean,
you're part of the value.
Part of the value back to the company.
Yeah.
Okay, and you also are incurring a early taxable event. Okay,
Yeah.
what we try to do is we try to say, do like Steve Jobs did in 2007 when he exercised 120,000 employee stock options to buy the stock at 5 when it was maybe 90. He exercised on the last day. He held the options that had a 10-year life for 9 years and 364 days. And then he exercised. James Dimon, the CEO of J.P. Morgan, exercised right at the end. John Chambers from Cisco, right at the end. Larry Ellison, the man of America's Cup fame, he exercised with a few weeks left. So he held them for 9 years and 10.5 months or something like that. But the real executives are holding them as long as they can. All right, if you can't afford to assume that risk to hold large amounts of money involved in these compensation options, you can reduce that risk without forfeiting any value and without incurring any taxable event by hedging. Hedging, and what I'm referring to is you sell calls. You sell exchange-traded calls, or sometimes you can strategically buy puts, or you can do them in combinations. And the result is different depending on how many you sell and how many puts you buy. If you want to protect against extreme moves, you'd be more of a put buyer. But the idea is to reduce the risk. You're making it such that you can hold these things longer, extend the life. It puts value in there, and you delay the taxes, and in some cases you can save taxes. Now, the companies don't particularly like you to do this because you effectively are raising the cost to the company. Okay? It's okay for Steve Jobs and Larry Ellison and Chambers and Dimon to do it, because they're holding it to the end. That's what they're supposed to do. That's the best advice. Okay? But the wealth managers and the companies, they don't encourage you to hedge them. And sometimes the plans absolutely prohibit you from doing it.
Yes.
Okay. So I don't want to be too long with that one.
Well, I think it went through about 3 questions here.
Okay.
But let's sort of recap a little bit. So first of all, folks, I want